So even though we go this complex system, in practice, that doesn't always work, right? Like sometimes we just need cash in our pocket because we can't, like, let's say I want to go buy some ink for my printer. I can't go through some crazy 1 week long process. I need just some cash to go buy it. And so we might allow some managers to have petty cash. Same thing, especially if you're in retail or bars, you might have a few $100 on cash on hand to go buy something urgent, like cups, if we run out of something. So these are just small payments, normally for postage, repair, supplies. So all we're doing for petty cash from an accounting perspective is we reallocate the cash to a petty cash account. Both of these are cash accounts. We're just classifying them differently. So we debit petty cash, credit cash. It's still a cash account. On our financial statements, there wouldn't be a different line item for this. It would just be for internal record keeping, we'd reclassify. And so then at the end of every month or week, we'd go through our petty cash account. So here we say, hey, we're giving Jim in management or Betty in management $75 in petty cash. At the end of the month, we'll look at, hey, give us your receipts. And Betty gives us our receipts for all the different things they used. They had $71.30 of expenses. And then we'll classify all of it in our accounting system. We'll say, hey, we had some miscellaneous expense. We had some inventory we purchased, a delivery expense, and office supplies for all of these. And then we'll credit the cash to reimburse for petty cash. And then if we want to increase or decrease it, we just debit or credit it accordingly. So I don't want you to overthink this. It's just saying instead of using cash from the business, we might give petty cash to someone running the business, and then we might just have to reconcile it at the end. If we want to increase the petty cash, we debit petty cash, credit cash. If we want to decrease the petty cash, we debit the cash, credit the petty cash. In practice, you don't see this a lot in businesses unless you're in retail or restaurants and entertainment. Most businesses nowadays use business credit cards to manage this process. And we talked about cash over and short already. Okay. So let's kind of go through how we reconcile this. We establish a $150 petty cash fund. When the fund balance reached $19 cash, we prepared a petty cash payment report. Identify the 4 internal control weaknesses from this payment report. And so on petty cash, I'm not going to really be bothering you too much with this on your midterms. It's just interesting to know about, but I think it's not that relevant from a business standpoint. But the internal controls are pretty interesting. So we should go over this. So if we go through here, we see that petty cash ticket number 14 is missing. So we see we're missing a receipt. That's an issue. We also see we don't know what account should be charged here, and no one approved this miscellaneous expense. So you can see us reviewing this, we can say, hey, this manager or whoever received the petty cash really didn't document this appropriately. And then here's the entry we would need for the petty cash. So we'd go through and we'd just identify all the, first we'd give the petty cash debit and credit. We'd reclassify the cash as petty cash by crediting cash and debiting petty cash, both of which are assets, both of which have debit normal balances. And then we'd reimburse. When we reimburse, we'd then expense everything or capitalize it. So delivery would be expensed, inventory would be capitalized. And then if there is over or short, we'd have we'd have the plug here. Not too worried about that piece. I think we all understand this. Here's things that any bank will give you, right? They'll give you credit cards, bank accounts, checks, electric fund transfers, deposit tickets, and bank statements. Does anyone have any questions related to what these are, or is this common knowledge? Yeah, deposit ticket, good question. I have a few questions on the board. So a deposit ticket, that means that when we go to the bank, we've actually deposited the cash. So if I have $1,000 cash and I give it to the bank, they'll give me a ticket saying that I deposited that money. It's proof that I deposited money in the bank. few other questions. In terms of negotiating for a company for payments to date, how do you push for another company to pay sooner or your company to pay later? So I guess the question here is, how do we negotiate payments? There's a whole science behind it, but it's just negotiation. Like, I can tell a company that I'm not going to do business with them unless they let me pay after 60 days. And I can tell a customer that I require them to pay me within 15 days. It's just part of your negotiation process. We could go over terms, but it's kind of out of the scope of like this class. Petty cash. And then another question, what is petty cash? Is it actually cash handed to someone, or is it just saying that the person will reimburse money? So petty cash, you think of it like a credit card for someone. Like, I'm actually letting a manager have $100 of the business's cash, but they need to give it back at the end of the month, right? Or tell me how they used it for the business. Does that make sense? Any other questions? Okay. So here's where we're going to be spending a lot of our time, is bank statements and bank statement reconciliations. This can get interesting and complex because we know from a reporting standpoint, we have to account for transactions within a period, right? We might be generally a year or 3 months or a month. And so if we're doing a year of transactions, we have this issue at the end of the year. We have some cash that's owed to us that we may have received as a check, but isn't in our bank, right? It takes time for all of this to process. So at the end of every period, we have to do bank reconciliations to make sure that that we are accurately reporting the cash that we have on hand. As an accountant, this is going to probably be your first job as a professional. Like, almost everyone has to do bank reconciliations their first year of accounting. Even if in any profession, in tax, in audit, in financial accounting, you need to know how to do a bank reconciliation. So pay attention to this. This is actually really practical. This is your first, if you even go become a bookkeeper for QuickBooks right now, this is what you do. You'd have to know how to do bank reconciliations. So before we can do a bank reconciliation, we have to know what a bank statement is and what information is on it. So once a month, we'll get a bank statement from a company, our bank, and it'll tell us how much was on our bank statement previously, the total checks we've received, or total debits to our account or increases in our account, total deposits, and our current balance. Total checks and debits. Remember, the debits from a bank is the bank's debit. So it's our credits. So their debits means that it's reduced our amounts. And our deposits are credits to them. They owe us that money. So that's where the bank statements get confusing, and that's where everyone gets confused from debits and credits. But the whole idea here is we want to make sure that our current balance is actually the true amount, which is why we'll do a bank reconciliation.